Welcome to Countats. In this lesson, we're going to be looking at the payback period. We're going to look at how to calculate the years, the months, as well as the days. In our previous lesson, we looked at the payback period and we looked at how to calculate the payback period, but in those ones, we calculate only the years and the days. But here, we'll show how to calculate the years, the months, and the days, as some have requested. Now, what is the payback period? The payback period calculates the amount of time it takes to recover the initial investment amount of an investment from the project's net cash inflows. In essence, we want to know, if we're going to invest in a project, how long is it going to take us to recover the amount that we have invested in that specific project? And that is what the payback period will tell you. The rule is, if the payback period is less than the maximum time allowed, then invest in the project. But if it is greater than the maximum time allowed, then don't invest in the project. What do we mean by the time allowed? Well, we mean if the company wants to recover its investment in 3 years' time, and you calculate the payback period for that specific project, and it gives you 2 years, 200 days, that means that it's less than the 3 years. That means you will accept the project and you will invest in the project. But if it's greater than 3 years, where a company wants its payback period to be only 3 years, then you will reject the project because it will take the company longer than 3 years to recover its initial investment. So what is the formula for calculating the payback period? Well, here's an important note. To calculate the exact period, we need to make an important assumption that cash flows are earned equally throughout the period. If cash flows are not earned equally throughout the period, then the payback period will not be accurate because you're not earning the money evenly. So we are assuming that the cash flows are earned equally throughout the period. So the first way of calculating the payback period is how we have done before, as I mentioned in the beginning, is where we calculated the payback period and we got the answer in years and days only. And that is the first method. And you can see here, the example is where your answer comes out as 2 years, 234 days. But the reason some students have requested this is because their question may say, give your answer in years, months, and days. So that's what we're going to look at here. And the formula we looked at the last time is the years before full recovery plus unrecovered cash flow at the beginning of the full recovery year divided by the cash flow during the full recovery year multiplied by 365. Now, if this is not making sense to you at all, then you've probably not checked out our lesson where we used this same formula. So I would encourage you to check that one out before you check this one out. But even if you check this one out, you should be able to understand how to outline your answer in years, months, and days. That's the second way we will calculate it. And that's where your answer will come out as 2 years, 6 months, and 14 days, for example. So that's what we're going to do just now. And what is the formula for that? Well, you'll have to do it in steps. The first step is where you get the number of years. And how do we get the number of years? Well, you just take the years before full recovery. As you can see, it's similar to the first formula, years before full recovery. And that will give you the amount of years. And how do we get the months? Well, we take the unrecovered cash flow at the beginning of full recovery year divided by the cash flow during the full recovery year multiplied by 12. And you can see the difference between the two formulas. On top here we multiplied by 365, but here we are multiplying it by 12 to get the number of months, okay? And when we get the answer in months, we'll just take the whole number and ignore the decimal. We will not include the decimal. And here's where we'll use the decimal. It's going to be the decimals that we have calculated in step 2 multiplied by 30 days. That is how we will get the number of days. So let me repeat, for us to get the number of years, you will just take the years before full recovery, and we'll go through some examples for you to understand this one here if you're not understanding what these formulas are and how they work. So for the number of years, we take the years before full recovery. For the number of months, we'll take the unrecovered cash flow at the beginning of full recovery year divided by the cash flow during the full recovery year multiplied by 12. And then we just take the whole number without the decimals. But here we'll take only the decimals we have found in step 2, which is this one here. And we'll multiply that by 30 days to give us the number of days. And that is where we'll have the answer in years, months, and days. Now let's go to the examples and apply these formulas. Here's our first example. We are told that an investment of 80,000 Rand is needed for a project that will take a duration of 5 years with no salvage value and will result in the following returns. And we have the returns from year 1 all the way to year 5. And we are asked to calculate the payback period, indicating the years, months, and days. So that is how we'll apply the second formula that I mentioned. So what is the first thing that we'll do? Well, we are going to put what is called the cumulative cash flow column, and then we'll be adding all the cash flows at the end of each period, how much it has accumulated to. So the first thing we'll do here is to add another column where we have our cumulative cash flows, and that is where we see at the end of each year how much have we accumulated in total, or how much cash flows have we received back in total. So let's add that column, cumulative cash flow, and then at the end of the first year our cash flow is 20,000 Rand. So that is our cumulative cash flow at the end of period 1, or at the end of year 1. And then we go to year 2. At the end of year 2 we have 30,000 Rand. So what is our cumulative cash flow in total? We will take our cumulative cash flow at year 1 plus the cash flow at year 2. So it's the 20,000 Rand plus the 30,000 Rand, and we get 50,000 Rand. And then at the end of year 3, what is our cumulative cash flow? Well, we'll take our 50,000 Rand plus our 34,000 Rand, and it gives us an amount of 84,000 Rand. But as we do this, we are paying attention to our initial investment. What is our initial investment? Well, it's 80,000 Rand. So have we passed that 80,000 Rand mark? Yes, we have. At the end of year 3, we will have received back a total of 84,000 Rand. That's why I'm adding this column here. Some people don't have to add it. In fact, you don't have to add it if you just write them down somewhere, but I'm adding it here for a good display. So we have 84,000 Rand. That means we have surpassed our initial investment. Remember, we are calculating our payback period. We want to know at exactly when are we receiving our initial investment. Well, by the end of year 3 we will have surpassed that mark, so we stop there, and let me move it to the left so that we can have space to do our calculation here. So we know that we will have received all our money between year 2 and year 3, okay, because we know by the end of year 3 we'll have received back more than the initial investment. So what do? Let's bring up our formula. The first thing is to calculate the number of years it takes us to receive back our initial investment of 80,000 Rand. So the formula is years before full recovery. And that's the easiest one to do. What is the years before full recovery? Well, we know the full recovery year is year 3, because that is when we fully recover our amount and surpass it. So the year before full recovery is year 2. So our answer is going to be 2 years. Now we are looking for the months and the days. So let's do the months first. What is our formula? Well, this is the one that we showed when we looked at our formulas. It's the unrecovered cash flow at the beginning of full recovery year divided by cash flow during the full recovery year times 12 months. So what is the unrecovered cash flow at the beginning of full recovery year? Well, like I mentioned, the full recovery year is the year where we completely recover our initial investment, and that is year 3. So the unrecovered cash flow at the beginning of year 3 is the same as the unrecovered cash flow at the end of year 2. It's the same thing. End of year 2, beginning of year 3 is the same thing. Okay. So what is the unrecovered cash flow, or the cash flows we haven't recovered yet at the beginning of year 3? Well, we know by the end of year 2 we will have recovered 50,000 Rand. So that means how much have we not recovered yet? That's the unrecovered cash flow at the beginning of full recovery year. Well, we'll take the initial investment of 80,000 Rand minus the 50,000 Rand, and we'll know how much we have not recovered. And then we'll have our numerator. And what is our denominator? Cash flow during the full recovery year. That's also an easy one. Well, we know the full recovery year is year 3, and we know that the cash flow at year 3 is the 34,000 Rand. So we'll take our numerator, divide by the 34,000 Rand times 12, and here's our answer. The numerator is the 80,000 Rand initial investment minus the 50,000 Rand cumulative cash flow at the end of year 2, and we'll get our unrecovered cash flow at the beginning of full recovery year, and then we divide that by the cash flow during the full recovery year of 34,000 Rand, and then we multiply it finally by 12 months, and we get 10.59 months. That is how many months it's going to take us after 2 years to recover our initial investment. So we will ignore the 0.59, the decimal, and just put the months as 10 months. Now we can calculate the amount of days. So we know it's going to take us 2 years, 10 months. But how many days? Well, here's how we'll do that. It's also an easy one. Remember the formula. It's only the decimals in step 2 times 30 days. And what is the decimal in step 2? Well, it's the 0.59 you see here. So let me make this one smaller, and then we put in here our calculation is the 0.59 times 30 days, and it gives us 17.70 days. And once you have that, you have your full answer. It's 2 years, 10 months, and 17.70 days. But remember, we round off to a full day or a whole day. That means it's 18 days, and that is our answer. So what is the payback period for this project? Well, it's 2 years, 10 months, and 18 days. I hope it has made sense, and I hope you can see how we do this when we have to put the answer in years, months, and days. Now let's do another example to gauge whether you have understood what we've been doing here. Maybe where students get confused is what is the full recovery year, and what is the cash flow at full recovery year, or what is the cumulative cash flow. But remember, the full recovery year is where you fully recover your investment. Remember, at year 2 we had not fully recovered our investment because we had only received a total of 50,000 rand cumulative, meaning adding the previous years and year 2 as well. We've only received 50,000 rand. So that is not the full recovery year. The full recovery year is year 3, because not only have we recovered the 80,000 rand, but we've received over that. We've received 84,000 rand. That is why that is our full recovery year. Now let's look at our second example. Here it is, and we looked at this exact same example when we calculated the payback period in the first lesson, like I mentioned in the beginning, but there we only put the answer in years and in days. So if you'd like to know how, and you looked at that example, you can try it here. Before we continue with this example, you can pause the video here, attempt the question yourself, and then you can continue with the video and see whether you understand how to do it. So pause the video right here, attempt the question, and compare your final answer to mine. Okay, I hope you have done so. Now let's get into it. We are told here that Ego Limited has just made an investment of 420,000 rand in a state-of-the-art wheel alignment machine, details of which are below. Expected useful life is 6 years, straight line depreciation with a salvage value of 120,000 rand. Expected cash flows after tax are as follows. And we are given cash flows from year 1 to year 6. Now we will not take into account depreciation here. And why is that? Well, because we're given cash flows. If we're given profits, that's when we would have to add back our depreciation. But in this case, we're given the cash flows. So we'll just work with cash flows. Remember, the payback period uses cash flows and not profits. Now let's get into it. The first thing is to create an extra column for cumulative cash flows, and that's where we'll add all our cash flows at the end of each year plus the cash flows at the end of the previous years. Now at the end of the first year, we will have received 66,000 rand. So that means our cumulative cash flows for the project so far at the end of year 1 is 66,000 rand. At the end of year 2, it's 96,000 rand the cash flow. But how much will we have received in total? Well, it's the cumulative cash flow at the end of year 1, which is the 66,000 rand, plus the 96,000 rand at year 2, and it will give us 162,000 rand. That means that by the end of year 2, the project has returned to us 162,000 rand. Remember, our initial investment is the 420,000 rand. So we want to see when exactly we get to that mark or we surpass that mark. Okay, and then at the end of year 3, well, we get 126,000 rand. So by the end of year 3, we will have recovered the 162,000 plus the 126,000 rand, and it will give us an amount of 288,000 rand. Have we recovered our initial investment yet? No, because our initial investment is 420,000 rand, and we have only recovered 288,000 rand by the end of year 3. And then by the end of year 4, we have received a cash flow of 181,000 rand, but in total we will have received the 288,000 rand plus the 181,000 rand, and it gives us a total of 469,000 rand. Now, have we recovered our initial investment? Yes, we have. Remember, our initial investment is 420,000 rand, and we have recovered way beyond that. We have recovered 469,000 rand. So we'll stop there, and that is how we do it in the payback period. So we know that we will have recovered our amount somewhere between year 3 and year 4. Now let's detail our answer in years, in months, and in days. Well, what is the formula for the years? Well, it's easy. It's the years before full recovery. Well, we know that our full recovery year is year 4, because that's when we fully recover our cash flow and even recover more than that. At year 3, we have not recovered our cash flow yet. So we want the year before full recovery. Well, we know that the full recovery is year 4, and we know that the years before full recovery is year 3. So our answer will begin with 3 years. And then we look for the months. How do we calculate the months? Well, remember our formula. It's the unrecovered cash flow at beginning of full recovery year divided by the cash flow during the full recovery year multiplied by 12. So what is the unrecovered cash flow at the beginning of full recovery year? In other words, what is the cash flow that is not recovered at the beginning of the 4th year? Well, it's the same as the cash flows that are not recovered at the end of the 3rd year. So by the end of the 3rd year, we've only recovered 288,000 rand. So we'll take the initial investment of 420,000 rand minus the 288,000 rand to see the unrecovered cash flow. How much have we not recovered yet by the end of the 3rd year or by the beginning of the 4th year? And then we divide that answer by the cash flow during the full recovery year, which is the 181,000 rand. That is how much we are receiving in the full recovery year, which is year 4. And what does that give us? Well, we'll have to multiply that answer by 12, and it will give us an answer of 8.75 months. I hope it's getting clearer now. And your answer, if you attempted this question before we continued, is the same as mine. So we know that it's 3 years and 8 months. Remember, we ignore the decimal first, and then we bring in the decimal when we are calculating the number of days. So how do we calculate the days? It's only the decimals in step 2, which is the 0.75 times the 30 days. So we'll take the 0.75 that we calculated here. We only take the decimal times 30 days in a month, and it gives us 22.50 days. So we will have to round that up to 23 days, and we'll put it down here. So our answer is 3 years, 8 months, and 23 days. I hope it has made sense. I hope you got the exact same answer as mine. Now remember, if someone puts 22 days and I put 23 days, we'll probably all be marked correctly because there's a slight rounding off differences. Or if someone puts 24 days instead of 23, it's just a rounding off differences. But as long as you get something very close to that. So it's 3 years, 8 months, and 23 days. And that is how you calculate the payback period when you're required to put the answer in years, months, and in days. I hope it has made sense. Now, in our previous lesson, we had looked at the advantages and the disadvantages of the payback period. So we'll quickly look at them here again. The advantages: it is easy to understand and to calculate, as you may have seen, and hopefully it was easy enough for you. It adjusts for uncertainty of later cash flows. Now remember, the more you project your cash flows, or the longer the amount of time you project your cash flows, the more uncertain it may be because you do not know what will happen in the future. So it adjusts for that. So we know by 3 years, 8 months, and 23 days, for instance, we'll have received our initial investment. So whatever happens after that, we know we have recovered our initial investment. And another one, it serves as a criterion to measure liquidity, because the quicker the initial investment is paid off, the earlier the generated cash is available for alternate use. Remember, we want to receive our money as quick as possible. So the payback period will be able to determine that for us, so that we know how soon will we receive our money and how soon can we use it for other purposes. And what are the disadvantages of the payback period? Well, it ignores time value of money. Remember, we just took the cash flows. We didn't discount them to see what is the value of this money today. It ignores the time value of money. But the NPV, or the net present value, does not ignore the time value of money. That's why we also use the net present value, which we have done a lesson on. You'll find the link to that lesson in the description below. It insists on a cut-off period, meaning by the time you recover your initial investment, you stop doing your calculation. Remember, after the full recovery year, we stop there. So we do not take into account the cash flows after that period. So that's another disadvantage of the payback period. It ignores cash flows beyond the cutoff period, and that's what I've just mentioned. And there is a definite bias against long-term projects that require a large research and development outlay. Remember, the payback period will be biased towards longer projects, and it will favor shorter projects regardless of what the benefits may be in the long run for the longer project. It ignores the order in which cash flows occur within the payback period, so it does not take that into account as well. It ignores that order, meaning if you are receiving very high cash flows in the early years, well, the payback period may tell you you'll receive your money very quickly, but it will ignore potential losses that will happen after the cut-off period. It does not consider the cost of capital in any way. Remember, we didn't use the cost of capital or the required rate of return or the weighted average cost of capital. We didn't take it into account in the payback period. It does not use the cost of capital here. It makes no distinction between projects of different sizes with different capital requirements and with different lifetimes. It does not make a distinction between them. It just tells you how soon you'll receive your money. So if you have a project where you only have to invest 1,000 Rand and you are getting returns which is 1,000 or 2,000 Rand, it will tell you when you'll receive it back. But if someone else has another project, or you have another project you're considering where you'll receive 1 million Rand and then you'll have high returns after that, which is 1 million Rand, 2 million Rand, the payback period will not take that into account. It just tells you which one will give you your money back quickly, and that is why it's another disadvantage. And those are the advantages and the disadvantages of the payback period. I hope it has made sense. I hope this example made sense. If it has, please let us know in the comment section below. And if you have gained value in this lesson, please subscribe to our channel, like this video, and share it to those you think it might help. And as usual, we provide one-on-one lessons. If you'd require one-on-one sessions with us, you'll find our information in the description below. Till next time, cheers.